Today we're going to talk about the auto industry, particularly in the Australian market, in 2023, on the back of some questions that we've been receiving from our listeners on where we see things happening as far as the industry, new cars, used cars, dealerships, customers and fleet. So there's a lot at play and a lot changing in this very dynamic market. Let's jump into it. With 30 years experience in auto logistics and state-of-the-art locations in 5 major Australian cities, Precar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies and original equipment manufacturers. Please visit precar.com.au and click on the link to Fleet Services. Put our predictions forward that it's going to be a 1.1 new car market, but there's a lot of things happening from an economic perspective and also from a market dynamic perspective. Firstly, looking at the economics, because we know that people don't professionally buy cars unless you're in a fleet situation. But the majority of people buy cars for a purpose to fulfill a need for transportation and mobility. And we keep forgetting that because us in the auto industry, we always get preoccupied about engines, transmissions, fuel types, electric cars. But ultimately, it's about fulfilling a purpose. And the time you buy a car is actually when you have a life-changing event. So we need to keep pulling it back to the reality that buying a car comes down to life-changing events. And right now, there's a lot happening in life to justify some changing events taking place. John, your thoughts on the first life-changing event, which is inflation and the Reserve Banks globally, their actions in trying to curb that?
Mark, I think there's a lot happening in the world economies at the moment. You're seeing high inflation across all markets, across the US. The Federal Reserve are busy raising interest rates at the moment. There's a good chance that we might have another 4 interest rises from the RBA in Australia. So this is going to put a lot of pressure, especially on people who are sitting with mortgages and they're coming up to renew some of the fixed term contracts. That's all going to put pressure on them. But exactly when that will start to impact will vary. But I think over the next 18 months, there's a lot of people going to have to come up to renew their mortgage. And that's going to start putting them under a lot of pressure.
Because it's a very valid point. Now, when we look at that inflationary pressure and interest rates, so here we have is a market that was primarily driven by private buyers. Now, private buyers and also catch up from a supply perspective. And we saw winners and losers from the Asian markets that we predicted 2 years ago that that's where all the volume in this country comes from. So when you have a hole, the one thing the market doesn't tolerate is a void. So we saw the Europeans starved of supply this year. So a lot of the Euro brands went backwards year on year from 21 to 22. That supply should come back on as the capacity catches up. Because the other things that are happening globally is that car companies supply their local markets first because they get cash in fast from those markets. They build the car, they send it to the dealer, they make money straight away. Well, building a car, putting it on a boat, send it halfway around the world, you wait 2-3 months for your money. That's very slow. So you always look after your local markets first. So what you're going to get is car companies are going to get a lot of inventory coming in this year. And it's going to start catching up probably towards the second half of the year. Now, the double whammy is going to happen with that second half of the year because that's when the interest rates will start to really hit. And the average age of the new car buyer is actually 50 years old. Now, those 50-year-olds are smack bang in the middle of a refinancing situation with their houses, and a lot of them are coming out of fixed terms that were very convenient, and many have actually gone out and overextended by buying a more expensive house with very low interest rates 2-3 years ago. So now we've got a situation where those loans are compromised potentially, or they're going to take up all this capacity that was going to be spared for an additional new car purchase. So we're going to see 2 things happening. Supply kicking in second half of the year, and you're going to get a tightening of access to funds and also a drop in demand. As soon as you get that, you then get a drop in prices. So you will start to see some price drop, which is what the Reserve Bank wants. Now, everyone's loved having their used car price go up, and if you bought the right model a couple of years ago, you've actually enjoyed a lot of capital growth out of your car. That is not natural in this industry. Cars depreciate. They're a depreciating asset. So you're going to get back to that depreciating asset situation. So that means used car prices, the car you own right now is going to be worth less. And it's going to be worth a lot less in the second half of this year. But the upside is a newer car is going to be worth less too. The price of that will drop. Now, this is where when you're getting dropping used car prices, dropping new car prices, this is where it's a bit of a dynamic. If I'm a fleet customer, I'm looking at my residual value and thinking, I'm going to be paying more for my leases because the residual values are going to be lower than what they were, say, 2-3 years ago. So here we have a situation of lease rates going up. If I'm a dealer, I'm going to get more inventory pressure because I'm going to actually be paying more floor plan or interest on stock that is not not sold that I'm carrying, which I haven't been doing for the last 2 years because I've had no stock. And if I had stock, it was low interest rates. Same time, my margins are going to start dropping because I'm going to have to start discounting to start clearing stock. And I need to make sure my sales processes are good because I need to maximize the margins I do get. So it's that whole conundrum of we've got supply and demand converging, where supply is starting to catch up and overtake demand, and demand is going to drop down.
Yeah, Mark, I think the big thing about that is trying to work out when does that actually going to happen. Is it going to be something that's reasonably quick, so mid-year, or is it going to be the end part of the year or early next year? If you can judge that correctly, I think you'll have the least impact on your business, because then you can start adjusting your used car stock levels, start adjusting what you're paying for used cars. You normally turn over the used car within 30 days, but there might be some older stock which previously you could sit on for 2-3 months and not worry about it because you'd still have a strong used car price. But if those prices are continually dropping, you don't want to sit with older stock that's sitting for 2-3 months, because if the price continues to drop, you could lose a significant amount on one of those cars. So it's trying to judge this and understand exactly what's happening and then make decisions from that with the best knowledge you have at the time.
And this is where the dealers have to be on the ball. The fleet companies need to be on the ball as well, because they're going to be exposed because there'll be costs involved for those guys. The small and medium enterprises, they need to be on the ball. If they're going to change their cars over, they need to be aware of what's going to be an easy model to get, and also what's going to be a model that's going to retain as much residual as possible versus the cars that are going to flood the market, which we haven't had flooding here for since 2019. So here we'll have those pressures coming in again. The reason for that is that no manufacturer accepts going backwards from a volume perspective. And the justification over the last 2 years for the national sales companies up to their parents is that, well, you can't supply me cars. That justifies me not getting my increase in market share or volume. So that's now changing because those local markets will have been satisfied. The factories still need to have capacity taken up, and they will flick around and say, well, you've ordered these vehicles over the last 2 years. You're now getting them. And your target national sales company is X, and you must achieve that, which then means you end up in a push situation, and we're going to see demos. So really the canary in the mine is when you start to see or demonstrator sales. Well, once you start seeing those, you know it is on, that the discounting cycle is starting, and that cycle will be here very much so in the second half of this year. The stock has been ordered. The factories have already ordered the parts to build the cars across the globe, so that capacity can't be switched off quickly, and no one's going to be switching it off right now. So right now you've got an 8-month lead time for those components, for your drivetrains, your powertrains, etc., and other components. So they've locked in. The colour is the only thing that can probably be varied at this stage.
Mark, I think you bring up a very good point there, because you might have found that dealers have been placing orders because they've been in such short supply, but a lot of those orders were not filled. So it's quite important for a dealer to understand exactly what orders are in the system for him and whether they've been cancelled completely because they weren't supply or they're still hanging in the system. So he needs to probably investigate and see, okay, what stock's going to be coming and when it's going to be arriving, and then work back to that. What customers are in line to take delivery of vehicles, and what's the risk of some of those customers cancelling orders? Because you have to then do a risk assessment of what stock's coming, when it's coming, because there are going to be customers cancelling. There's nothing you can do. So these are the things you need to be looking at quite closely if you are a dealer. Mark, just one other question for me is, some companies started providing guaranteed residuals. Do you think there's a risk that some of those vehicles will be overpriced when they start to come back into the market?
It's a very good question, John. The guaranteed future value product, I think, is sensational. It's a brilliant idea. It's something that we've looked at in many of the OEMs that we've been involved in, and some have been successful, some haven't been. If the brand is naturally strong at used car pricing or used car values and residual values, those brands won't have a problem. The challenge will be for the brands that are marginal, that have heavy discounting cycles. Those brands tend to suffer when it comes time for guaranteed future values, where the risk is taken by the dealer and also by the finance company and potentially the OEM as well. So usually it's a tripartite risk sharing arrangement. Now, most of those will be structured appropriately. It all comes down to what did they set that residual value at. In most instances, it's a fairly conservative guaranteed future value. And that's where a lot of the customers retain the vehicles and don't actually hand them back. If you have a collapsing residual value, then you're going to get the OEM and potentially the dealer and the finance company will be exposed. So it's a plus for the customers that had those guaranteed futures. If they have been bullish, the finance company and the OEM and the dealer was bullish in setting the residual value, well, there may be a few challenges there. But very much it's a win for the customer. But I think you'll find that most of the brands that have gone down that path of guaranteed future value, GFE, are very strong brands with good track records in the used car space. The VFACTS data on the Australian market for 2022 indicates a couple of interesting trends. EVs jumped up to be 3% of the market, which is great. So 33,000 electric cars out of 1,080,000 is not a lot of cars still. The other thing that when you start to look a bit deeper down in the numbers, we still see the passenger cars continue to contract. They've been contracting for the last 10 years. SUVs were just over 50% of the market. They're now in the high 50% of the market. But there was actually a reduction in the medium pickup and cab chassis. Now, the two best-selling cars are medium pickup and cab chassis. And that was a surprise to see that segment actually going backwards year on year, albeit a few thousand units, but it still went backwards, whereas SUVs continue to go from strength to strength. But then when you do a deep dive and look into, well, who went backwards by buyer type? Business went backwards year on year. Now, that's a surprise because there's been instant asset write-off for business purchases. So businesses pulled forward a lot of activity in previous years, but it's not continuing to that same level, given that supply, has been constrained, but pickup and cab chassis have not been that constrained. So here we have a situation where we've got SUVs getting stronger, but it's the private market that's enjoying that, not the business market. Maybe a bit of business confidence not being there right now, or maybe they've already spent their money and now there's a bit of a normalisation from a supply perspective. We know supply still has been tight, but right now it's freeing up and will continue to free up as we get into the first half of this year, and the second half will really be the telltale. So second half of this year, 1.1 million cars. Let's see how correct we are with the change in market post July 2023.